What if you discovered you're unknowingly losing hundreds, even thousands, of your hard-earned dollars to taxes every single year? The shocking truth is, nearly 70% of taxpayers are doing exactly that. And it's not because they're trying to, it's because they're making common, avoidable mistakes. Taxes are an inevitable part of life, often feeling daunting. Yet, while the tax code is complex, many common, costly mistakes are surprisingly avoidable. Today, we'll compare two typical tax approaches and show you how to shift from losing money to keeping more of your hard-earned cash, moving from reactive, costly mistakes to proactive, smart tax management. Think of it, the wing it and hope for the best approach that costs you big versus the strategic and savvy approach where you truly take control. Which one do you want to be? Let's dive in. Option A, the wing it and hope for the best approach. Many of us have walked this path, especially when starting out or life gets hectic. Tax season rolls around, often in late February or March, and panic sets in. You frantically gather documents, a W-2 here, a 1099 there, often missing key statements buried in an old email or a stack of papers. But here's the critical mistake most people make: procrastination and lack of organization. When you rush, you're stressed, tired, and much more prone to making errors. These errors aren't just inconvenient, they can be incredibly costly. Forgetting a deduction, miscalculating income, or submitting incomplete information can lead to a smaller refund, or even worse, an audit. The IRS penalty for failing to file on time is 5% of unpaid taxes per month, capping at 25% of your bill. That's real money, and the mental toll of that last-minute scramble and lingering worry is often as bad as the financial hit. I remember my friend Sarah. Every year, without fail, she'd be up until midnight on April 14th, chugging coffee, trying to make sense of her freelance income and various receipts. One year, she completely forgot about her student loan interest deduction, which was a good chunk of change, simply because she hadn't opened the statement when it arrived months earlier. By the time she realized it, it was too late to amend her return easily, and that money was just gone. It's easy to think, oh, it's just a small deduction, it won't make a huge difference. But those small deductions add up significantly, especially over years. Forgetting something like a charitable donation, medical expenses, or even job search expenses, if you qualify, can leave hundreds, if not thousands of dollars on the table. So what's the alternative to this stressful, costly cycle? It's what I like to call the proactive planning approach. Instead of waiting, adopt a year-round mindset. Set up a simple system to track income and expenses, a dedicated folder, an email tag, or a budgeting app. The key is making information gathering easy. This also means a mid-year check-in. Around July or August, review your income and withholding. Too much or too little withheld. A quick W-4 adjustment prevents a huge tax bill or an interest-free loan to the government. This approach reduces stress, minimizes errors, and empowers you to find missed deductions and credits. Option B, the set-it-and-forget-it approach. Even if you're organized, another common trap is the set-it-and-forget-it mentality. Simply inputting numbers into tax software without understanding your situation or assuming it hasn't changed. The biggest mistake? Not understanding legitimate tax breaks. The tax code offers deductions and credits to help different groups and encourage behaviors like retirement saving or education. But if you don't know they exist, you can't claim them. Now, here's a distinction that trips up almost everyone: deductions versus credits. Deductions reduce your taxable income. For example, if you earn $60,000 and have $5,000 in deductions, you're only taxed on $55,000. The amount you save depends on your tax bracket. Credits, on the other hand, directly reduce your tax bill, dollar for dollar. A $1,000 credit reduces your tax bill by a full $1,000. Credits are almost always more valuable than deductions. Imagine leaving a $100 bill on the ground daily. That's missing legitimate deductions and credits. The Earned Income Tax Credit, EITC, for instance, can be worth over $7,000 for a qualifying family, yet billions go unclaimed annually because eligible individuals don't know they qualify or how to claim it. Other common ones: child tax credit, up to $2,000 per qualifying child. Student loan interest deduction, for those still paying off student debt. Health Savings Account, HSA, contributions. A fantastic triple tax-advantaged way to save for healthcare. Retirement contributions. Money you put into a traditional IRA or 401k reduces your taxable income. I recently helped a friend who assumed he couldn't deduct anything because he was just a regular W-2 employee. But after a quick chat, we realized he had made significant contributions to his traditional IRA, which he hadn't even thought to include. And he also had some unreimbursed job expenses, though those are less common now. That conversation alone saved him several $100s. It's not about finding loopholes, it's about claiming what you're rightfully owed. So, how do you flip the script from losing money to maximizing your returns? It's the strategic tax optimization approach. This means educating yourself, even just a little, about potential tax breaks. IRS.gov is a treasure trove, and most tax software offers built-in questionnaires for common deductions and credits. Consider life changes, marriage, a child, home purchase, schooling, or a side hustle. All impact your taxes and open new deduction credit opportunities. Don't assume last year's form reflects this year. When in doubt, especially with complex situations, consult a qualified tax professional. Their fee could easily be offset by what they save you. The verdict: be proactive, be strategic. Comparing the wing it and set it and forget it approaches to proactive planning and strategic optimization, the choice is clear. One path leads to stress, missed opportunities, and costly errors. The other leads to peace of mind, financial empowerment, and keeping more of your hard-earned money. It's not about avoiding taxes. It's about legally and ethically managing your taxes in a way that aligns with your financial goals. Every dollar you save on taxes is a dollar you can put towards your emergency fund, pay down debt, or invest for your future. It's a fundamental pillar of smart personal finance. Your actionable takeaway today. Here's what I want you to do this week. 1. Start a tax folder, physical or digital, right now. From this moment forward, any financial document you receive that looks like it might be tax-related, put it in that folder. W-2s, 1099s, bank statements, receipts for charitable donations, student loan interest forms, everything. 2. Spend 30 minutes researching one potential deduction or credit that might apply to your unique situation. Are you a student, a parent, a homeowner? Just type IRS your situation, tax credit into your search engine. You might be surprised by what you find. 3. Review your W-4 withholding. Head over to the IRS Tax Withholding Estimator online. It's free and can help you adjust your withholding to avoid a big tax bill or a too large refund next year. Taking these small steps won't just save you money, they'll give you a sense of control and confidence over your finances that is truly priceless. Remember, this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor or tax professional before making financial decisions. If you found this helpful, please give this video a thumbs up, subscribe for more friendly financial advice, and let me know in the comments below. What's one tax mistake you've learned from? I'd love to hear your stories. Thanks for watching, and I'll see you next time.